Neil, we have CPIs today, and I feel like it could be quite an important figure. Inflation's been sort of hot topic last couple of weeks. What's your thoughts? First, explain what CPIs are.
Consumer Price Index is the biggest figure for inflation.
Yeah.
I wrote it down here before I came in. 42% housing, then there's food, transportation, medical care and entertainment, and apparel afterwards. So it basically comes to everything that is inflationary as such. So therefore it affects the market and therefore affects the GDP later on.
Yeah. So basically where more money's been printed recently, prices generally will go up.
I think we're all aware that inflation has gone up, food price and everything else. Well, the most interesting one obviously petrol.
Yeah.
Most people see that petrol pump's gone up a few pence, and therefore it affects the price of the market. However, the best way to solve inflation is to raise rates.
Yeah.
However, this is where your theory.
So this is to raise interest rates.
Yes, this is where your theory hurts. Is that currently the Fed, the Federal Reserve, want inflation to be higher.
Why?
It affects the economy and it makes it best for the economy. The inflation's been no inflation for 10 years. Okay. Hence why interest rates are so low, everything else. Yeah. So basically, they want inflation higher, up to 2.5–3%.
Okay.
So your view is that if the CPI is higher, we should sell the indices.
Yep.
However, we've got Mr. Powell talking at 7 o'clock tonight.
Yep.
Strange to stay.
And also buy the dollar.
Yeah. Yeah. Obviously, the rates will go up. So, do we say to 130 today that if the CPI is better?
Yeah.
And remember, the CPI and the PPI are the two figures that were opposite. Every other figure higher, you buy the indices. CPI and PPI, both inflationary, is different.
Reason is different is purely because it's an indicator to raise interest rates, which is not good for
but,
right?
As an old wise man said, if the CPI is bad, or higher rather, i.e. more inflationary, you sell T-bonds. And the T-bonds recently have been telling us that inflation is in the air, the whiff of inflation. So you're saying, I would say at 130, if the CPI is higher than 0.4, 0.5, I would sell T-bonds or T-notes or T-bills rather than indices.
Yeah, makes a lot of sense. Right contract for the right reason.
Yes.
Okay. So in terms of higher, expected is 0.2%, I believe.
On the year. Not on the other month.
On the month, and then year on year 1.5%.
Yes, and Powell says they want inflation of 2.5%. So it's a weird one.
It's a weird one.
Yeah.
But I think if we see it at maybe 1.8%, 1.9%.
What, on a month?
No, on the year.
Yeah, you want it. I think it should be higher.
Yeah.
So in a way, if it is higher, it's not a shock. If it's lower, it's a worry.
But it's signs of inflation.
Yeah. If it's lower, then I think you would be worried. But again, we bounce on 6 hours' time. Mr. Powell speaks at 7 o'clock.
Okay. So yeah, interesting one today. 130 CPIs.